Every market bubble shares one dangerous belief: that this time, the rules don't apply, that history is outdated, that optimism is intelligence. It has destroyed fortunes before, and it's happening again right now. History has a habit of repeating itself, especially in financial markets. Investors convince themselves that the past no longer matters, that old warnings are irrelevant, and that today's market is somehow immune to collapse. Legendary investor Sir John Templeton, who averaged nearly 15% annual returns for almost 4 decades, had a phrase for this mindset. He called it the 4 most expensive words in the English language. This time is different. Those words have emptied more brokerage accounts than any recession ever could. Blind optimism, when dressed up as intelligence, becomes incredibly expensive. And that brings us to one of the most famous traders in market history, Jesse Livermore. Livermore was a pioneer of speculative trading. His life inspired the classic book Reminiscences of a Stock Operator, and he became legendary for making massive fortunes by betting against markets during crashes. Livermore once said, "There is nothing new on Wall Street. Speculation is as old as civilization itself. What happens today has already happened before, and it will happen again." There is one market bubble that perfectly proves his point. A bubble few investors talk about anymore. One that looks uncomfortably similar to today's market. It wasn't the dot-com bubble, and it wasn't the 2008 financial crisis. It was something quieter, more subtle, and far more dangerous. It was the Nifty 50 bubble of the early 1970s. When it burst, the damage was brutal. The stock market fell nearly 50%. Some of the largest companies in the world lost 60 to 80% of their value. Inflation surged from 3% to over 11%, and the market took almost 8 years just to break even again. The story begins in the late 1960s. America was riding a massive economic high after World War II. Factories were booming, suburbs were spreading, and paychecks were growing. Confidence was everywhere. The United States saw itself as unstoppable, and for the first time in history, the average American truly believed prosperity was permanent. From 1945 to 1970, U.S. stocks rose more than 350%. It was one of the greatest bull markets ever recorded. During this run, a new investment philosophy became wildly popular. It was called one-decision investing. The idea was simple: buy companies so dominant, so powerful, and so stable that there was only one decision to ever make: buy and never sell. These companies became known as the Nifty 50. They weren't risky startups or speculative bets. They were household names like Coca-Cola, McDonald's, American Express, Xerox, and Polaroid. Investors believed these companies were bulletproof. Selling them was considered foolish. Valuations didn't matter. Price didn't matter. Only faith mattered. And that's when the danger quietly set in. Because in investing, when something appears to have zero downside, it usually carries the greatest risk of all. By the early 1970s, Nifty 50 stocks weren't just expensive. They were priced as if economic gravity no longer existed. At the time, the overall market traded at a reasonable price-to-earnings ratio of about 15, normal and sustainable. But the Nifty 50 lived in a different universe. Coca-Cola traded at 46 times earnings, Xerox at 49, McDonald's at 86, Polaroid near 90. On average, Nifty 50 stocks traded above 40 times earnings. The concentration was extreme. The top 5 Nifty 50 companies made up roughly a quarter of the entire stock market. The full group represented nearly 45% of total market value. Investors didn't realize it, but by buying index funds, they were making one massive concentrated bet. Then reality arrived. Between 1973 and 1974, oil prices quadrupled. Inflation exploded past 11%. Unemployment doubled. President Nixon abandoned the gold standard. The stock market collapsed nearly 50% in the worst bear market since the Great Depression. Overpriced stocks didn't gently correct. They were destroyed. Coca-Cola fell more than 60%. McDonald's dropped over 70%. Polaroid collapsed over 90%. The so-called one-decision stocks became one long financial nightmare. And the worst part wasn't the crash. It was the wait. There was no quick recovery, no V-shaped rebound. The market didn't fully recover until 1981. 8 years of stagnation, 8 years of lost opportunity, 8 years of broken confidence. If this feels familiar, it should. Mark Twain once said that history doesn't repeat itself, but it rhymes. And today's market rhymes loudly with 1972. Back then, the Nifty 50 dominated the market. Today, it's the Magnificent Seven. 7 technology giants now make up roughly 36% of the S&P 500. Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia. 7 companies carrying the weight of the entire market. They are innovative. They are powerful. They dominate their industries. But so did Xerox. So did Polaroid. So did Avon. The story hasn't changed. Only the names have. And once again, valuations seem optional. Google and Meta trade near 28 times earnings. Amazon around 35. Apple near 37. Microsoft close to 38. Nvidia around 50. And Tesla trades at well over 200 times earnings. These are great companies, but they are also overweighted, overpriced, and treated as if they are untouchable. Just like in the early 1970s. Investors are telling themselves the same story. These companies will grow forever. They can't fail. This time is different. Warren Buffett once summed it up perfectly. What we learn from history is that people don't learn from history. And here we are again, staring at a top-heavy market, ignoring valuations, trusting optimism over math, and quietly whispering the most expensive words in investing. This time, it's different.